Hi friends, welcome back. So inflation data is out. We're talking about CPI and it came in hotter than expected. I want to go over some of the headlines, share my thoughts and get yours as well. So first headline, markets slash rate cut bets. Looks like the rate cuts aren't coming according to markets after US inflation rises to 3.5%. Moreover, another headline, hot inflation report derails case for Fed's June rate cut. Again, don't expect it anytime soon. CPI rose 3.5% in March, while core prices stayed strong. And so you can see here, core is at 3.8%. Overall, we're at 3.5. We're going to go over the details of the numbers, but I also want to see what the Fed is saying and what people are saying around the market. Powell's soft landing dream, I guess it's a dream now, in danger as traders hedge inflation. And actually, they just released the minutes. We'll go over some of the quotes of that. And this is the minutes from the last meeting. Fed wants more confidence that inflation is moving towards 2%. Minutes indicate. So basically, they always say they're dependent on the data. So where's the data headed? Let's take a look at this. So as FOMC members voted to keep language in the post-meeting statement that they wouldn't be cutting rates until they gained, quote, greater confidence, right? So they need greater confidence that inflation was on a steady path to the bank's central 2% annual target. So they want to see the data that, hey, it's obviously going in the right direction. In terms of inflation, the data is showing it's obviously going in the right direction. We seeped back up. So again, we're at, what was it, core 3.8, overall 3.5. So again, not so great. Here's another quote from the minutes. Participants, talking about the Fed here, participants generally noted their uncertainty about the persistence of high inflation and expressed the view that recent data had not increase their confidence, right? So they're not confident that necessarily we're going to that 2%, that inflation was moving sustainably down to 2%. And then here's some of the factors that is on their mind. You can see here, and what apparently was a lengthy discussion, so I guess they're talking about this quite a bit, about inflation at the meeting, officials said geopolitical turmoil, rising energy prices, which we talked about just yesterday, both these things where I was saying from the U.S. government / White House perspective, they need to quell the fighting in the Middle East, both in terms of oil prices and also trying to keep all of the allies happy and enemies, you could say as well. I mean, they're trying to essentially, what the U.S. is trying to be friends with everyone. Hard to do though, and these kind of things also too with the energy prices coming in the summer. I do expect there to be I don't know, spike's the right word. We'll just say uptick. Which is seasonal, right? So during summer travel months, and then also too after that, then you got the winter months, etc. So I don't imagine that this is going to go away anytime soon. And you guys already know this stuff. Inflation is sticky. We're going to go over some like what's going up in price and stuff, etc. But I want to finish going over this and what the Fed is talking about. And then they're saying here, yes, these rising energy prices and geopolitical turmoil could push inflation higher. They also cited potential for looser policy could also add to price pressures, meaning that if they cut too soon, give out a bunch of free money to everybody, that would also not help with inflation. On the downside, so things going on in the world, they cited more balanced labor market, enhanced technology with economic weakness in China, and a deteriorating commercial real estate market. So we talk about all these things all the time. So always appreciate you guys coming back and as we talk about all the stuff that's happening. It was interesting. We had a debate in the comment section on the last video when we talked about what to expect today from CPI data. And again, it came in hot. It is what is a normal rate? And I think a lot of it depends on how old you are. So for us older folks, if you guys don't know, I'm 49. So I remember the 1980s, and I remember this craziness when we had double-digit interest rates, right? A lot of young people have never seen that kind of stuff before. So for it depends on how old you are and like what you remember and what to be normal. Some people might think that this 0% stuff is normal. I would argue no, it's not. And you can certainly make the case sort of where we are as normal, and don't necessarily expect it to go back to zero anytime soon. The other thing too that's really interesting is we talked about this, that the hedge funds were essentially short bonds. And took a lot of leverage bets, meaning they borrowed a bunch of money to essentially bet against bonds, and then yields are now spiking. So it looks like they got that right. Moreover, which is also interesting, it looks like they're selling off U.S. bonds and buying European ones, thinking buy them now before they cut. That's the Europeans, that is. And we'll read through this details here. It says Big investors are selling U.S. Treasuries, buying European government bonds, betting that cooler inflation in Europe, and I'd like to hear from our friends in Europe if you agree or disagree with this cooler inflation stuff. I'm not in Europe, so just no comment on that. Will allow its central bank to start cutting rates sooner than the Fed Reserve. So we're talking about PIMCO, JP Morgan, and T. Rowe Price have all increased their exposure to European government debt in recent weeks, right? And moreover, it's actually quite interesting that they were saying here, markets are currently pricing in 3 or 4 ECB rate cuts by the end compared to only 2 or 3 for the Fed. But, this is a market, so markets be crazy. My particular stance, and I don't think the Fed's going to cut, but who knows? They could do one. I mean, just to keep the politics happy in the USA. I will say, though, there was a big spike in the 2-year yield and also the 10-year. So the bonds go down, yields go up. This is right here. So this is the 2-year. It's approaching 5%. I can see right there. So 4.98. And then it's actually really interesting. You can see this upward path there in the yields. And then this is was that the same one? No. Yeah, this is the 10-year, and the 10-year's at 4.56, and you also have the steady increase as well. Moreover, I was looking at this. The dollar's really strong right now, and the one that really stood out to me is the dollar to the euro, which I didn't even know was like this great, because I do look at these currencies, but I didn't realize it was this strong. So I guess that $1 is 0.92 euro, which is pretty good. You can see to the yen, it's 152 yen. To the Australian dollar, 1.5. Again, pretty good. I can just tell you guys, I'm in Korea, so we're at 1366. So $1 is 1,366 Korean won, which is very, very good. And to put this into perspective, I first came to Korea back in 2009, and the dollar was basically all-time highs, at least on this chart. Currently we're here. My wife and I, we actually came to Korea about this period here as well. So I'll just say it's no coincidence that I left the country at these times. Moreover, if you want to hear about sort of my experiences abroad, etc., you can check out my book. It's called Positive Angle, and I write a lot about these kind of things. Essentially, it's all about looking for the best opportunities. So I know that not everyone can just go to Europe or go to Asia or whatever, but I'm just saying, guys, the dollar is really strong right now. Moreover, things are expensive everywhere. Let's take a look at what's going on here. So this was the CPI read, and you can see here the big one that really stood out was the juices. So my understanding of this one, I guess there was some sort of crazy shortage of oranges in Florida or something like that. You also have fuel costs and labor costs, but for those of you in Florida, you guys can let me know what's going on with orange juice and oranges and stuff like that. So I have noticed, though, that at least juice here in Korea is expensive also. It is related, so I think we do get some oranges from you guys. Beef, it says beef roasts are up. Baby formula is expensive right now, up 9%, 9.9, but yeah, the juices is the one at 27.5 up. And then you got sugar is also expensive, and that, again, I think that goes to help making the orange juice. Also, too, you have food away from home, up 4.2%. Vending machines, 6.2%. Electricity and gasoline, they're not going up as much as before, right? So this is where the danger is if energy really spikes. Like, we already have inflation higher than was estimated. Now if energy goes up even more, right, you guys can see where that's going. The other ones too, I thought this was an interesting one: video discs and other media. So I'm not buying this stuff, video discs and other media, but I guess it's up 30%. Insurance is still up. This is car insurance. We talked about this one. This one's been up quite a bit. And my understanding, this is a combination of how to fix the car parts and, car prices, etc. Moreover, repair of household items is up. Legal services up. Motor vehicle repair is up, right? This is an interesting one. And again, when you look at CPI data, they have all kinds of stuff in here. Garbage and trash collection at 5.8%. And parking fees and tolls. Emissions of sporting event, the inflation has cooled a bit, but this one spiked quite a bit. So we talked about this before. There was a massive demand for concerts and sports games and stuff like that. So those prices were quite up. And for those of you who've been going to any professional sports games lately, please let me know what the prices are. But this is another interesting one, and I just don't know. I'm not in USA. Have you noticed an increase in parking fees? How much you pay per the hour or whatever, or in tolls? I'd like to hear that. That's really an interesting one. and then also to rent on primary residence is also up. Those are the year. If you want to take a look at what's going on from month to month, I guess eggs spiked a bit, pork chops, and frozen fish and seafood. We wanted, or not, we wanted. What to say? Best way to say is, I guess, estimated was going to come in 0.3 month over month. Came in at 0.4. We just talked about that yesterday, and I wanted to also to talk about something we talked about yesterday as well. Just a slight collection to yesterday. I showed you guys this before. The headline was "More Americans Say They Are Living Paycheck to Paycheck this year compared to 2023." So I want to make sure that that's clear. You guys probably didn't pick up on my slide error there. I was just talking about years, and essentially this was saying things are worse for Americans in 2024 than 2023. My hunch though is, because I've seen this data before, is Americans are running out of savings. Because my understanding was in the past, prices had increased for many Americans, right? So Americans were struggling, but they still had a bit of cash on hand, and then they started dipping in, using credit cards, stuff like that. Now that cash is depleted, and this is sort of where in 2024 this may show up. So Americans have inflation problems, right? Interest rate, credit card debt, medical bills, etc. We also talked about this as well yesterday, but I just want to mention again, copper prices are high. Now, why do you talk about this stuff, commodities? So say we talk about Tesla a lot on this channel, or EVs, etc. So if the raw material to build said car / batteries is up, what do you think that's going to do to the car price, right? So the car company then would have a choice. I can pass the cost on to customers, or I can, essentially eat my margins, and that would hurt your stock. So they got to make choices on that. Obviously, then if they raise prices, that will probably cool demand, right? So this is always a challenge, and so this is why you track all of these kind of things. Regarding the market, though, you can see here most everything was down. The thing that I thought was crazy, at least as of recording, NVIDIA was green while like everything else is red. And I'm like, what is going on in NVIDIA? I didn't see any particular news. The only thing I saw, which is kind of funny one, was they're just saying, yo, NVIDIA's in correction territory. So I personally think this is a bubble. I called that, right about the top. And they said, yeah, it looks like the top, right? But we'll see. NVIDIA showed some strength today. You guys can explain that one to me. I was looking at it, I don't know what's going on with NVIDIA. Oil, because I don't, because everything else is red. I was like, what? Because even AMD, like other chip stocks are down, so it's kind of funky. Oil stocks are up a day as well. And also, too, this is actually really interesting. You can track it by different things that are going around. And I'm looking at consumers because the American consumer is really important to U.S. economy. So home builders really took a hit today. Then also, too, you have retail was down, and then gaming. The technology front, semiconductors were down, and also social media and robotics. And I mentioned the semiconductor thing again because I was like, what's up with NVIDIA? Now for you NVIDIA bulls, you can say, well, see, looks like we're the winners, everyone else is the losers. But I think they're all connected. And, if, for example, social media is taking a hit, and say, for example, Facebook doesn't have the money that they, said they would, and the orders aren't going to come in as strong from a company like that to, get all of your chips, et cetera. I think that'll affect NVIDIA, but we'll see. Now, in terms of politics, you do got to mention this. If inflation remains sticky, I think Biden's going to have a tough time in the election. It's just the reality of it. So do keep a track of this kind of thing. And obviously, if you're Trump, then you're going to be hitting Biden, blaming him all for inflation. And this is Politics 101. If things are going good, it's because of me. If things are going bad, it's because of the other guy. So that is Politics 101. So we'll see. I think this sets up for a really interesting fight. And if you want to hear some more thoughts about politics, I just made a video just yesterday, just the previous one about politics here in Korea. We just had an election, and a lot of interesting things to talk about. Now, what are people saying around the market regarding the CPI and the Fed? It's actually really fascinating. I got a bunch of quotes going around, and we're going to go over these things. Again, my personal opinion and stuff is I don't think the Fed should cut this year. And in fact, you could even put raising rates on the table, which a couple have floated. But we'll see if the dialogue and the discourse changes on that, in the coming month or so. So here, this is saying, quote from Charles Schwab: "It's often said that the Fed takes the escalator up and the elevator down when setting rates, but for the path downwards in this cycle, it looks like they will opt for the stairs." Moreover, it's actually interesting. We got a lot of quotes here. From people around the market. So this is that was Charles Schwab. This is Jason Pride from Glenmead. He says, "Inflation right now is like a stubborn child that refuses to heed the parent's call to leave the playground." This is really clever. I like this. Stubborn child that refused to leave the playground. 2 cuts is now likely the base case for 2024, down from 3. ago, and down also say from the 6 to 7 expected cuts. And I don't know what kind of crazy people were saying this stuff. I remember reading these articles before, and I told you guys all along, I was like, who really thinks I mean, is that really, are you serious? But no, I mean, obviously it's not happening. No 6 to 7 cuts. As a result, investors should be prepared for higher for longer monetary regime. Jamie Cox from Harris Financial says rates aren't going higher, but the distance to rate cut is another quarter. Apollo Global Management, they're saying here, easy financial conditions continue to provide significant tailwind to growth and inflation, right? So not changing anytime soon. As a result, the Fed is not done fighting inflation, and rates will stay higher for longer. Here's someone over at forex.com. They're saying no matter how you slice the data, it's hard to argue that inflation is falling, right? There's nowhere you can, make the case that it's going down. For a central bank that's looking for any sign that inflation was continuing to fall towards its target, this report will be a big disappointment for the Fed Reserve. Clearbridge, they say the battle between the sticky versus continued disinflationary narratives is moving decidedly towards an inflation backdrop that is plateauing and potentially accelerating. This inflation release effectively takes June off the table. Talking about cuts, are they coming or not? So June's off the table, according to this person, for the first rate cut, and should be push the odds further out with a coin toss in July or September. Like I said, it's always fun to hear what people have to say. Independent Advisor Alliance, this one's one of my favorite ones. Goldilocks has left the building, so we're referring to, can we have a soft landing? Not too high, not too low, right? Just right. Inflation isn't coming down anymore, and rate cut hopes are going to be pushed off even further in the future. We believe the Fed has a bias to cut rates and likely to still cut interest by 25 basis points, so 0.25 in July or September. But if inflation data remains sticky, then that may be only one rate cut we get this year, maybe the only rate cut we get this year. So, in that regard, right? So people are saying 2 to 3. This person's saying 1. I'm saying 0. Let's see what else people say. This is GAM Investments. For June rate cut optimists, right? If you really expected that June cut, this reading is a bit of a blow. Markets have been wrestling with the likelihood of the Federal Reserve delivering on 3 cuts this year. I don't know. But on these numbers, 2 rate cuts may now be more likely outcome. Okay, so we're still thinking possibly 2. E-Trade from Morgan Stanley, they're saying a third straight hotter than expected CPI may have been the final nail in the coffin for a June rate cut, but it remains to be seen whether 2024 will turn out to be a 2-cut year or something else or something less. The other question is whether the stock market will see this as more than a, quote, bump in the inflation road. We've seen sharp moves after other CPI surprises reverse in a day or two, but today's reaction in pre-market is an indication that recent volatility may have not run its course. Also, too, we have JP Morgan saying, that's the sound of the door slamming shut on the June rate cut. BMO, like I said, I like to read through this stuff. It's fun. It's fun to share with you guys, too. BMO Capital Markets, core CPI at 0.4%, talking about month over month, takes June cut off the table. Overall figures materially undermine the Fed's assumption that the January, February were slightly bump in the road towards normalization. So, they're just like, he's making a comment on, Ian, he's making a comment on the Fed, saying, don't worry about January, February, we're going to be fine in March, but that's appeared not to be the case. Here's someone at Bankrate. You can kiss a June interest rate cut goodbye. There is no improvement here. We're moving in the wrong direction. So you kind of see where market sentiment is on this stuff. Another person from Charles Schwab. In recent months, it has become clear that the journey to the Fed's target of 2% inflation will be bumpy. It's also often said that the Fed takes the escalator up, elevator down when setting rates, but I already read this one. Path of the downward cycle, it looks like they opt for the stairs. Here's the Premier Milton Diversified Funds. So it says here, U.S. economy is running along at quite a pace, and a June rate cut looks less and less likely. July or September is the call now. The Fed has some head scratching. Not so confident there. The Fed has some head scratching to do if other central banks were waiting for the Fed to move, and they have got a conundrum on their hands now. Also, Goldman Sachs, they say here, the rates market needs to seriously consider likelihood of higher for longer, a minimum lasting through summer and potentially through the end of the year. This number did not eclipse the Fed's confidence. It did, however, cast a shadow on it. Ouch. Principal Asset Management says this marks the third consecutive strong reading, talking about inflation here, meaning that the stalled and disinflationary narrative can no longer be called a blip. Meaning that talking about that, January, February, ignore those numbers. It's just kind of freezing for a bit because you guys, inflation is going the other direction, right? And also too, it says here, in fact, even if inflation were to cool next month to more comfortable reading, there is likely sufficient caution within the Fed now to mean that a July cut may also be a stretch. So that's coming from Principal Asset Management. Again, we track this data all the time. I always enjoy talking with you guys about this stuff. Love to hear your thoughts on any one of these things. We looked at a bunch of data today. We looked at what's going on in the market and different things that are happening. So that's my thoughts. I'd like to hear yours as well. Please like, subscribe, of course. Leave your thoughts in the comments, and I'll catch you all in the next video.